Hey guys, it's Max. How's everyone doing? How about a little end of day rundown and see what happened? Had a busy day at the station, had a decent interview with Jay. I asked a bunch of stupid questions. I don't know. I didn't prepare very well for the interview because I was busy doing my own thing and focusing on my own stuff lately. But anyway, it was probably my worst interview just as far as me saying stupid stuff. Didn't know what Mobileye was. Oh my gosh. All right. Of course, I know what Mobileye was. All right. Let's take a look here at the Ultiverse, the Ulti grid. I did get a lot of, Jay's a wealth of information, and we got a lot of new information from him. We also figured out the Max has dyslexia because I had looked at the Disney trade as being a risk reversal, thinking he'd sold puts to buy calls. Well, actually, he had sold puts and sold calls, aka a iron condor. So anyway, but I'm going to go back and check the Ulti grid and make sure it's accurate. Well, anyway, let's check the Ultiverse. Okay, this damn target's killing us, but he had on you. We talked about that one. He saved himself 2/3 of what he would have lost with the old formula. 2/3. Still was a big loss. It lost. It was still a big loss. Lost 8% when it could have lost 26%, though. So, all right. So Ulti was down a little bit on the day, but so were the average stocks. The ones that were up, where Mara was doing really well. MicroStrategies. What's still with SMCI getting delisted? I guess that's a thing now. SMCI listed. I'm just trying to pull up an article on it. Rises. So they're trying to avoid it, but they aren't in compliance. Oh my gosh. Okay. So somebody's asking me what will happen to SMCY. I think SMCY will be gone, but I don't think you'll lose any money. They'll just, but it's a good question though. The option contracts that are open, if a company's delisted and you have sold a call, I would think that means full profit. The company, it went to zero, right? Full profit. But wonder if you had some kind of put selling. You wonder if you'd sold calls and put. How did they handle that? Let me do a little research and I'll find out. It looks like they're trying to avoid it. So we'll see. Let me do a little research. I should have asked Jay, but pretty sure they'll just give your money back and you'll have to switch it over to NVDY or ULTY or one of the other. There's a lot of other, or not a lot. There's a couple of other funds that pay in that yield range that you might be happy with. Okay, so let's go over here. What else should we look at in the Ultiverse? Well, let's look the Ulti grid. Now, right here where I have, this is, gosh darn it, I cannot believe this. This whole time, this Disney trade, because I guess I have dyslexia, has been a iron condor. Well, anyway, that's fine. The iron condors really aren't my favorite trade. So, iron condor. But I had a whole line of questions to ask him about risk reversals that I didn't get to, or because he's really not doing them that much. He mentioned he did one kind of just as a one-off on Netflix, and I saw that and loved the strategy. I'm going to try to talk him into doing some more. Okay, there we go. But anyway, my bad on that. All right, the trades are out for today. So they didn't make a lot of trades today. Here's all the trades today. They sold some ZIM. They sold 87,000 shares, but at the same time, they did also sell short a 285 call for next week, and they bought a 250 put, aka a caller. So they still it looks like they must still have some shares left, but they did. They're cutting that position down. Then over here, this one, 310,000 shares. That's going to be Billy, B-I-L-I. So on that one, they're closing a position. Yeah. Looks like they're done with Billy. Looks like Billy's going to be off the ULTY grid tomorrow. In the morning, they'll publish the positions, and I'll update the ULTY grid. But it looks like, let's sort of call them to the right. It looks like on Billy, we're going to be able to put out, or we don't put out anymore, but it's going to be out. All right, so now let's go to the index buffer report. Love me some index funds. Look at old XFAL. Look at XFAL just killing it. So let's go see what happened. So if XFAL's killing it, XFAL is sensitive to volatility in a good way, meaning if volatility pops, XFAL can profit, which is one of the few funds that that does what it does in the way it does. I've interviewed the founder, Rob. I really liked him, and I really like XFAL. Look at this. It's up 1.39%. Let's get it on a daily. It's too illiquid to look at it. Should maybe even look at it on a weekly. Boy, that's a good looking chart. Now, this thing doesn't pay a huge dividend. In fact, it barely pays one at all. But if he could just figure out how to up the dividend a little bit, maybe we need to put him together with old Cy from Tap Alpha. And if Cy could teach him how to squeeze just a little bit more yield out of this thing, because this thing is a great hedge. You see, one of their biggest days ever was August 5th because they own volatility options as a hedge. Anyway, so that was one of their biggest days of the year. Now, the next day, volatility shrunk right back down, so their price, settled right back to where it had been. But the point is, had that August 5th, if that turned into a multi-week, from a 10% pullback to a 20 or 30% pullback that lasted, instead of 1 week, that lasted 3 weeks or 3 months, this would have been all over it. And this, this fund was very well positioned. I really like the way there's just not another fund out there like this. Don't sleep on this one. It's a good way to get long exposure to the market, but it does not pay much of a dividend. So it's a good substitute for it's like growth stock plus a hedge. Let's get a weekly chart on this. See if that looks any better. All right, let's overlay a weekly chart of the SPY. See how it looks. Oh, shit, I screwed that up. Oh, well, I wanted to put it on a different, move to new pane above. Okay, I got them each on their own pane now. Okay, so this, look at this. Oh, there's the parent asset. Here's the Menendez brothers. This is Lyle or Eric. I don't know which one. But they're doing a great job. Catching upside. Okay, so now let's look at XFAL this one other way. Compare XFAL to Z-Hedge. That's another fund that keeps you invested, but also has a built-in hedge, but it's supposed to give you market type returns. Let's see what this looks like. Okay, well, they're pretty close. I mean, I wouldn't even declare a winner. I'm trying to see which one's blue and which one's black. It doesn't even matter. I mean, I guess it does a little bit. I mean, I guess it actually is a pretty big difference when you annualize it. Well, XFAL's, is up about 4%, where Z-Hedge is up about 3%. So no, it's really not that much of a difference. XFAL is catching just a little bit more NAV. Now let's see on the dividends though. See, Z-Hedge has paid out $1.12 in the same time period that XFAL's paid out 69 cents. All right. So, and Z-Hedge has just paid out $1.12 in 3 years. So that's not a very big dividend. I think it pays like 6 or 8% or something. It's not a huge dividend payer. XFAL pays about half of that, or it doesn't even pay that much, evidently. Just 69 cents in 3 years. So these are not yielding, but if you want to have some exposure to risk assets and to have a built-in hedge, let's move this in a little bit closer. Let's move this into July of this year because it has the built-in hedge that I was talking about. I just zoomed in on the chart a little bit, but look how it's making money when the rest of the market's going to shit. You know, that was the worst one-day drop, or that was the worst 1 week drop of the year. I mean, April wasn't great, but I mean, August was it. August was the most vicious pullback we had, but it did not hurt XFAL. Buy and hedge, and it didn't hurt Z-Hedge either. Z-Hedge is just rolling along. All right, it's not only just about using options to generate a yield. That's one of many things you can use them for. People also use options, and they use them in ETFs to put on hedges or to enhance returns. You know, i.e., the leveraged funds, that the triple leveraged daily fund. I mean, you can use them for that. You don't have to use options just to pay a dividend or a yield. All right. Well, it looks like the market was pretty much straight sideways. So we had a bunch of underperformance down here in AIP. I mean, in NASDAQ land, they all underperformed. Well, that's, it's whatever. Over here in Russell land, looking really good. You would have to say Russell or IWMY, XFAL, CLIP are the funds of the day. I'm not including these because these are up every day or down that much every day. These are just a different. I don't care about those. Look at USOY though. That's really impressive too. Might have to say, well, and Riser is looking really good as well. Now, don't forget, lately interest rates have been going back up. Riser is an ETF that I really like. That's a fixed income ETF, but that is sensitive to interest rates going up in a good way, meaning if interest rates go up, this fixed income fund makes extra money, unlike most fixed income investments are sensitive to interest rates in a bad way. So Riser is a great hedged type situation, a great fund to put on with the to hedge other fixed income bonds and stuff. Riser should hedge out a bond portfolio, or should help. All right, single stock buffer report. I mean, it's all about MicroStrategies, up 4%. Parent was up 10%. Abney catching some upside. You could see SMCI selling off. The other one's flat or up slightly. All right, so let's look at charts now. All right, so let's throw that in the trash. I'm going to bring up Max's volatility metric. Okay, this is just on a weekly. Sometimes it's fun to scan out, but on a weekly basis, it got bullish this week back here, April. That was in April this year. Great time to get bullish. Then it got bearish July 15th. Great time to get bearish. Anyway, lately it has gone back. It's gone back and forth between bullish and bearish. It was bullish for just a little bit. Now it's back to bearish. Let's zoom in on the daily time frame and make sure it's still bearish. We're going to compare You can see where it switched from green to red. It switched from bullish to bearish. Unfortunately, the market has not cooperated and gone down so far. The market did go in our direction a little bit when it switched to bullish. That was nice. All right, so let's see if we're getting close to switching back to bullish. You heard me ask Jay about VIX and VIVIX today. VIVIX, he agreed with me. He concurred. VIVIX is still high. He said VIVIX is at 110 or something. I'm trying to get the damn freaking, it won't freaking let me grab the freaking edge of the freaking thing. There it is. Yeah, okay. So, and why is this over here? Regular. Yeah, I said VIVIX 110 is a no-go. Well, I don't do it that way. I'm saying VIVIX above the 200-day moving average is a no-go. Well, the 200-day moving average is at 93. So yeah, I'm agreeing with them up here in this, you know, this is where danger happens or whatever. We want to see a VIVIX like we saw back here this summer. And when we do see that, I'll be sure to let you guys know. But, you know, it's been a volatile late summer and fall. Now, hopefully the Santa Claus rally is getting ready to kick in again. My volatility system, tell you the truth, has obviously not been doing that great lately because it's a trend following system. Lately, the market really has gone more sideways than anything else. Look at Friday, October 11th. We're about at the same price we closed at on November 15th. We went nowhere in a month. Now, granted, we went down first, the end of October, then we shot up a little bit, but really went nowhere. And now we're just a little bit above nowhere, basically. So now let's scan back down to the 30 minutes. I use the 30-minute, I follow the 30-minute volatility and the daily volatility. So on the 30-minute, we have to pull up the 30-minute volatility, and it is still above the 230-minute period moving average. Not that there's anything special about that, but generally that's just, you have to draw lines somewhere. Generally, that's when bad stuff kind of tends to happen. Let's see. Oh, yeah, the mailman's here, so Jackson's probably going to bark. Jackson, I would like you not to bark, okay? Thank you. Thank you, Jackson. Let's scan in. That was VIVIX, which is VIX of VIX, a derivative of a derivative. Heck, this is VIX, which isn't anywhere close to being under the 200 period moving average. It's even trending up. You could draw a trend line from last Thursday to now. So somebody's worried about something. So we are definitely going to stay cautious. Now, VIX futures trade 24 hours, and they're the most retail or the most reactive. In other words, they're usually the first to turn. When it turns back to bullish, the VIX futures are the first ones to turn. But they also give a lot of false signals because they're kind of overly reactive. Well, right now, they're still firmly trending up. I mean, their moving average is even trending up. They're well above the line. So anyway, we are definitely going to stay cautious. So now this is the part of the show where we're going to talk options. And I want to look at a trade I gave you guys today. I had 2 options shows today, plus the Jay interview. But we had I really like this trade I showed you guys. A bearish way to hedge NVIDIA earnings. Now, unfortunately, it's after hours, and oh gosh. Well, I like the way this trade works. It doesn't mean it always works out. It looks like this time NVIDIA missed earnings, and it looks like it's going to land right in the valley of death. Oh gosh. Well, no, it's post-market. It's 144. I mean, 144. I mean, maybe it'll rally from there tomorrow. At 144 is about about a half loss. The max loss is 800, but about half loss is usually what I count on whenever I'm wrong. So yeah, that would probably we'll see how it opens in the morning. On that one, you're hoping that you're either right and it does terrible, which we were wrong. So that's great. But you're hoping you're either right or you're really wrong. And oh my gosh, no, NVIDIA did great. And it's actually up 5% after hours or something. All you're trying to avoid is like get down a little bit, down to 2 or 3%, which is what it did. So in any event, that's called a put ratio back spread. But then I had another show, or I may have been on the same show. I showed you how to do on NVIDIA a bearish. You could do it this way too. This is another way to put on a hedge. This is a bearish risk reversal. We're selling calls to finance puts. We sold 2 call spreads. Our call spreads have limited loss. We have about $900 in this trade. If NVIDIA did happen to drop way down, you make 1,000, 2,000, something like that, that's fine. If NVIDIA doesn't drop, this one can still make money. So if NVIDIA like just drops like 4%, like it's going to, this one you get to hang on to your income. So today, this was the better way to play NVIDIA earnings than the back spread. But there's some days if NVIDIA would have been up, this way would have lost $903, and the back spread method would have just kept the yield. So which way's best? It depends. I mean, it depends if you knew which way you were going to miss it. If you knew you were going to miss it this way, you would put on the back spread where you still have profit this way. If you knew what really happened was going to happen, you would have hedged it this way, because you would have, you'd made about 10% in 2 days. That's fine too. Risk 900, make 100, or risk 900, make 100. That's like 11% in 2 days. That'd been fine. And you never know, it could have missed. It might miss next quarter. And when it does miss, it's going to be glorious. That's the thing. If you do trades like this, where you can basically have insurance for free, or it's not really free, it's subsidized by other options, but buy insurance in a very smart, efficient way where you kind of build in a little lotto ticket for yourself. You can do these trades all the time. And there'll be a couple of stocks every earnings season that miss earnings big and that drop 30%. Look at Target. Here's the bullish target. Okay, well, the bearish target made 1,800. The bullish target lost 1,100. So starting to think just doing them both together might be the way to do it. It pisses me off when I do them both together and I still lose money, and that is possible. But on Target, it would have worked out nicely doing both together. Okay, so let's look at some other ones. Here's Williams-Sonoma. They had earnings today. It looks like they did poorly. Their bullish one made 2,100. Their bearish one lost 1,900, but that would have saved your ass, though. Let's look at Palo Alto Networks. Okay, here's a bullish Palo Alto Networks up 157. Here's a bearish Palo Alto Networks up 66. Now let's see how this happens. Oh, because the Palo Alto Networks barely moved. We didn't get the outlier move, so both of them won. Both of them just get to keep the little 10% consolation prize, right? The bullish Palo Alto. I wanted to show this trade too. So Palo Alto just has not moved. So if you did both of them in this case, that would be fine. You just make your little 10%. That's more like 15% on this leg. It tie up about $5,000. The one leg made about 15%, and then your bearish Palo Alto right here, it's only up 66 right now, but it's going to be up 262 by the end of the day on Friday, unless the price moves this way. But And then if it does that, it's partially offset from the other way. This was an extremely liquid. Well, it's not as liquid as NVIDIA. But anyway, they had a lot of strikes. They had a lot of selection of strikes. But actually, look at this. Bid at 325, asked at 870. It wasn't yesterday, though. It wasn't before earnings. It was an earnings play. You do an earnings play, that's why Jay does them, or one of the reasons. You get extra liquidity right around the time and extra volatility, so you should be able to get in. The theory is you should be able to get in. You should be able to get in good. Now, but getting out, though, I'm a little concerned about the wide bid-ask spread on the way out. But we'll see. This has a couple. These option trades have a couple more days to settle out. Lots of times, these prices right here, the max or the profit figure it's showing you is based on the last price. And really, the only bad trade of the day was this NVIDIA back spread, because it looks like it's going to land right on our freaking valley of death. All right, but I have a way to handle that too. We're going to have more content on we're going to have more content on hedging with back spreads. And we're going to have content on how to hedge NVDY with the back spread. But basically, the too long don't read is if you had 1,000 shares, then you could put this on every time they have earnings. So 4 times a year, the week they have earnings. All right. And you could even do it with less shares, but the math to me works really nice on 1,000 shares. 1,000 shares of NVDYs, it's about a $25,000 investment. It's paying about $1 a month for shares, $1,000 on 1,000 shares every month. So you'd have to when you put on a trade like this, you make a deal with yourself. If it lands in the middle, you basically lost for that month. You basically lost your yield. Let's say this opens tomorrow and it's down 400 or something. Of course, we would just close it and chalk it up to experience. Then you could wait, then just let NVDY do whatever NVDY does and wait till next quarter, the week before earnings. Put it on. You have all kinds of liquidity and volatility in front of earnings. Put on some kind of good trade like this. And if it lands in the middle of the valley of death, yeah, that sucks because your dividend's about 1,000, but and you're going to have to pay. In the case of this one, it looks like we're going to lose about 400. So your dividend would only be about 600 this time, this 1 month. But you basically have free insurance. You're not free. You made a deal. It's going to be paid, because what's going to happen a lot of times, you do this 4 times a year. 3 of the times NVIDIA is probably going to run this way. You're just going to get to keep the $125 on $900 or on $900 risk is about 25% for 2 or 3 days. Yeah. Hell yeah, we'll do that any day of the week. Occasionally it's going to land there. When it does, it's insured. It's covered by your dividends. It's just a deal you can make with yourself. Even if the worst case scenario, you do this 2 years, maybe one time it might land at the middle of the valley of death or something, but you would lose all your dividends for that month. That would suck. But I mean, they only have earnings 4 times a year. They have earnings once every quarter. So if you just did this 4 times a year, just in the week they had earnings, put on this trade, just in case you got your massive miss. Just in case you got your massive miss, then you could cash this option trade in for $2,000, $3,000, $4,000, whatever, and that would cushion a lot of the blow, because what's going to happen, this could easily drop from 25 to 20. What was that? All right, guys, I appreciate you all for being here. Hope you have a good day. Leave me a comment. Talk to you later. See ya.